Believe it or not, the most important point in trading is 20% skill and 80% psychology. It's not the charts, not the trends, but the mind that swings the pendulum of trading success. Today we dive into the book, Trading in the Zone by the renowned author Mark Douglas, a masterpiece that illuminates this very truth. It's a journey that takes us beyond the surface of trading, into the depths of our own psychology. So, let's delve into the wisdom of Mark Douglas and understand how to master the psychology of trading. Market analysis, contrary to popular belief, is not the road to stable profitability. Now, that might be a hard pill to swallow, but let's delve deeper. You see, many traders invest countless hours in market analysis, predicting price movements, and developing intricate strategies. However, these efforts often fall short in addressing the real culprits behind trading failures: lack of confidence, discipline, and concentration. Consider this. If trading was purely about market analysis, wouldn't all the seasoned analysts out there be trading millionaires by now? But we know that's not the case. The reason? Trading is not just about analyzing, it's about executing. And execution requires confidence. Confidence to pull the trigger when your analysis points to an opportunity. Confidence to stick with your trading plan even when the market seems to be moving against you. Discipline, on the other hand, is the cornerstone of consistent trading. It's what keeps you grounded when euphoria or despair threaten to sway your judgment. It's the force that compels you to stick to your trading rules, to cut losses when necessary, and to let profits run their course. Without discipline, even the most sophisticated market analysis is rendered useless. And let's not forget about concentration, the ability to focus on the task at hand, to filter out noise, and to stay attuned to critical market signals. In the world of trading, where countless distractions vie for your attention, maintaining concentration can be a daunting task. Yet it's a task that cannot be bypassed or delegated to market analysis. So if you find yourself obsessing over market analysis, take a step back. Ask yourself, am I using analysis as a crutch to compensate for my lack of confidence, discipline, or concentration? If the answer is yes, it's time to shift your focus. Remember, analysis is just a tool, not a solution to psychological shortcomings. It's there to assist you, to provide insights, to guide your decisions. But ultimately, the success of your trades hinges on your ability to confidently execute your trading plan, to stay disciplined in the face of market volatility, and to concentrate on what truly matters. Successful traders master a key skill: eliminating the influence of fear and recklessness. It's an art that requires commitment, discipline, and above all, a well-defined trading routine. Let's delve into this a bit deeper. Trading isn't about sporadic spurts of activity. It's about consistent action, day in, day out. Successful traders establish repeatable trading procedures and schedules that keep them on track. They have a clear plan about what markets they will be trading in, what time zones they'll be operating in, and what their responsibilities are. This allows them to eliminate the influence of fear and recklessness, two factors that can severely impact trading outcomes. Imagine this. It's 7:30 in the evening. You've got your cup of coffee and you're ready to dive into the world of trading. For the next half an hour, you're consumed with finding trading opportunities and building your watch list. By 8, you're executing your trades uninterrupted until 11. The last half hour of your day, that's for recording and reviewing your trades. But wait, you're a full-time employee trading part-time? No problem. At 8 in the morning, you're finding trading opportunities and placing limit or stop orders. During your lunch break, you're checking your portfolio to see if you've executed your trades correctly. And by the time you're winding down from work at 6, you're recording and reviewing your transactions. This is the sort of routine successful traders swear by. It's not about being at the right place at the right time. It's about being at the right place all the time. The more you're concerned about the profit and loss of your trading account, the more likely you are to develop bad trading habits. A disciplined routine helps you avoid this pitfall. So, here's the secret sauce to successful trading. Eliminate fear and recklessness by establishing a solid, repeatable trading routine. Use your time wisely to monitor your trading charts, to make informed decisions, to make money in the market. Remember, trading is a marathon, not a sprint. The more consistent you are, the more likely you are to succeed. And there you have it. Folks, a disciplined routine, devoid of fear and recklessness, can set you on a path of consistent trading success. Learning more about the market to avoid pain, ironically, creates more complications. This is the paradox we're diving into today. In our quest to master the market, we often pile on information, believing that more knowledge equals less risk and less pain. But, as Mark Douglas astutely points out in Trading in the Zone, this approach can backfire. Let's break down the trading process into 3 stages, as Douglas suggests, to better understand this paradox. Stage 1 is all about preparation. You conduct market analysis, do your due diligence, and make key decisions before entering a trade. You determine the entry point, the take-profit price, the stop-loss price, and the number of stocks to be purchased. Essentially, you're applying risk management principles to safeguard your investment. But here's where the paradox starts creeping in. The more you learn about the market, the more you start expecting from it. You've done your homework, you've analyzed the trends, and you've made your predictions. Now you expect the market to behave as you've anticipated. But the market, as we well know, is not a predictable beast. It dances to its own tune and rarely falls in step with our expectations. Moving on to stage 2, this is where the actual trading happens. You find entry positions, place stop-loss orders, and focus on identifying other trading opportunities. The key here is not to be glued to your trades out of boredom or anxiety. Don't undo or expand your stops based on a whim or someone else's opinion. Remember, trading requires discipline and the ability to stick to your plan. And yet, the paradox persists. The more you learn, the more you expect. And when the market doesn't deliver, disappointment sets in. You question your strategies, your decisions, and your abilities. But it's not you, it's the market. It's unpredictable, volatile, and immune to our expectations. Finally, we reach stage 3, which happens after the transaction. You write a log chart, take screenshots of the chart, review your thought process, and evaluate your execution. It's a time for reflection and learning. And then you repeat stage 1 armed with more knowledge and hopefully more wisdom. But remember our paradox, the more we learn, the more we expect. And the more we expect, the more we're setting ourselves up for disappointment. It's a vicious cycle that can lead to frustration, self-doubt, and ultimately, poor trading decisions. So what's the solution? How do we break free from this paradox? The answer lies in the wisdom of Mark Douglas. In the end, he says, stick to your rules, disregard others' opinions, and let the market do the talking. The market is a complex, ever-changing entity. We can study it, analyze it, and learn from it, but we can never fully predict or control it. And that's the beauty of trading. It's not about having all the answers. It's about navigating the unknown with confidence, discipline, and a solid set of rules. So let's embrace the paradox of learning more. Let's use our knowledge not to set unrealistic expectations, but to make informed decisions, to mitigate risks, and to ride the waves of the market with grace and resilience. In the end, stick to your rules, disregard others' opinions, and let the market do the talking. The best traders possess a unique trait, the ability to stop their losses without hesitation. Now that's a simple statement, but it carries a profound truth. It's not about making the most out of every trade, it's about knowing when to cut your losses and move on. This ability is pivotal in trading. How do successful traders achieve this? By employing automatic stop-loss orders. These are preset orders placed with a broker to sell a security when it reaches a certain price. The beauty of these orders is that they take the emotional component out of the decision-making process. Let's delve deeper. When a trade is going south, it's easy to fall into the trap of hoping, wishing, even praying that the market will turn around. But hope is not a strategy in trading. In fact, it can lead to catastrophic losses. Automatic stop-loss orders prevent this from happening. They allow objective decisions to be made ahead of time, minimizing the risk of emotional trading. But it's not just about setting these orders. It's also about sticking to them. Some traders set stop-loss orders only to cancel them when the price gets close. This is a dangerous game to play. It's like driving a car without a seatbelt, hoping you'll never need it. So, what's the magic behind stop-loss orders? They provide a safety net, a line in the sand that, if crossed, triggers a sale. This way, you can limit your losses, protect your capital, and live to trade another day. But remember, setting the right stop-loss order is an art. It should be neither too tight, that you get stopped out prematurely, nor too wide, that it doesn't serve its protective purpose. It needs to be just right, based on your risk tolerance and the volatility of the security you're trading. In conclusion, the best traders know that they can't control the market. What they can control, however, is their response to the market. And one of the most effective responses is using automatic stop-loss orders to manage risk and make objective decisions. Remember, Hesitation can be your worst enemy in trading. Fear, a common human emotion, can ironically hinder our growth in trading. It's like a double-edged sword. On one side, it can keep us from making rash decisions, and on the other, it can paralyze us, preventing us from taking necessary actions. Fear of losing money, fear of missing out, fear of making a mistake. These are all common fears that traders experience. But here's the thing. Fear can make it difficult for us to learn new things and adapt to market changes. It can make us stick to old habits, even when they're not working anymore. We might become too afraid to try new strategies or explore different markets. We might fear the unknown so much that we miss out on great opportunities. This is where the beauty of trading comes in. It's not just about making money, it's also about growing as a person. It's about learning to face our fears, to take calculated risks, to adapt and to learn continuously. In trading, as in life, fear will always be there. It's part of being human. But the key is not to let it control us. We need to learn to manage our fear, to use it as a tool rather than let it become an obstacle. Remember, no one ever said trading would be easy. It takes courage, discipline, and a willingness to learn from our mistakes. And most importantly, it takes a willingness to face our fears. To succeed, you must conquer your fear and embrace continuous learning. Now that we've delved into the key points of trading in the zone, let's summarize what we've learned. Market analysis, while important, is not the golden ticket to profitability. It's the discipline, confidence, and concentration that truly make the difference. Successful traders eliminate fear and recklessness, establishing repeatable trading routines and responsibilities. The more we learn about the market, the more we expect from it, creating a paradox of knowledge. It's crucial to let your rules guide your trades rather than the opinions of others. Even the best traders know when to cut their losses when the market signals a trade is no longer valid. Fear can be a barrier to learning new things, yet continuous learning is key to profitability. In essence, trading in the zone teaches us that trading is 20% skill and 80% psychology. Remember, in trading, it's not just about skill, but mastering your mind. Don't forget to like this video and subscribe to our channel for more insights.